Hello and welcome to a continuation of problem 7-9. We were partway through step 3, and so let's continue on. Now we're actually getting into the good stuff. This is something we have not seen before. We're dealing with intercompany transaction regarding a depreciable asset. So in this case, we have that patent that had a book value of 185, proceeds were 160, eyeballing it, $25,000 difference, so we need to actually amortize it over 5 years. Now, don't be too caught up with the fact that it's like negative amortization. That will just sort of flip our transactions from being debits to credits, but the overall purpose is still there. So we have year 2. Now, don't forget what the goal is. The goal is to reflect that that transaction has never occurred. So we're going to need to start backing things out. The year 2 opening will be $25,000. That has not changed. Years 3 and 4 amortization that has probably occurred to date is $10,000, right? Because it's $5,000 per year. Now let's think about this a little bit. The adjustment. What accounts are we hitting? So in this case, we want to debit the patent and really bring it up to its original value. The offsetting entry, though, is also going to offset the patent. Why? Because we're able to bring it down. We're amortizing it. Now the tax impacts in the years 2, 3, 4, we don't need to worry about. Really what we're going to be more focused on is our year 5, sort of our current transactions. So our opening, now we can see above where our positioning is. 25 here, offsetting 10 there, so 15,000. Year 5 amortization is still just going to be the regular 5,000. We're not changing that. But let's think about some of the accounts we're going to hit. Well, if we want to be amortizing it over a certain period of time, we're going to treat it very similar to what we would any other depreciable asset. So we're going to debit our amortization expense, and we are going to credit the patent. Oops, so I'm like, oh, same font, there we are. So it's very similar treatment to what we've done in prior years. Now, the tax impacts, we do need to start capturing it here. So take the 40%, $6,000. That is going to credit our deferred tax. That's going to be a balance sheet account. And then down here, we can't forget about it. So let's times that by 0.4. And it's going to be a credit to our tax expense. And then we are going to debit our deferred tax. Oops. Let's tab that over. Debit deferred tax, as the transaction has not actually occurred yet. So they really shouldn't have ever paid tax on it. Originally, of course, CRA doesn't look at it from that perspective. CRA looks at it from a legal entity perspective. But for accounting purpose, we almost need to assume that that transaction has never occurred. What's our final position? In this case, we can just take the difference between the two. It will be the 9,000. And we need to consider what accounts we're going to be impacting. So it is a current amount, because we're in the current year. We're talking about an asset. So first things, it will be SANA. We also have some transactions in there pertaining to the previous years, right? So how do we get the 15,000? Well, it was based on prior year transactions. So we're also going to need to impact our SOAR account because it's opening retained earnings. That's where these transactions had flew into before. On the year 5 amortization, we'll do the same kind of thing. We'll look at the difference between the two. We can easily eyeball that as 3,000. Let's just hop back in there. We are still going to impact SANA, but we also have to impact SANI. So the reason why we need to impact SANI is because we have that amortization expense and tax expense. Of course, both of those would appear on the income statement. And that will be offset with SANA for the patent itself and, of course, that deferred tax. Make that capital. There we are. So now we have the year 5 at closing, which is going to be the difference between the 15 and the 5, and also the 6 and the 2. And last but not least, the 9 less the 3. Because remember, that is an opening position, so we technically back that out, and then the closing amount will add it back in. Now we're ready to start looking at some of these other transactions. So we had the land in year 3. Porter was selling it to Sloan, which means it's a downstream transaction. How does that impact it? Mainly on the consolidated version, we're going to need to be impacting POR rather than SOR. But let's just enter our figures here. We know the difference between the two items was $21,000. That was provided in the question. Then, from a tax perspective, we're still just going to take that 40%. They haven't given us enough information to do a different kind of, or more detailed tax calculation. And then, let's do the difference between the two. 12,600. What are we impacting here? Well, we want to credit lands. Remember that land was overvalued when it exchanged hands, so we are going to need to back that out. Just a reminder, Porter sold the land for $93, but it was only ever on their books for $72. So let's back off that extra amount. We'll need to offset that with our deferred income tax. We're just going to call that. And of course, like I already mentioned, POR. Why POR? Because this is a downstream transaction. The big issue here is on the parent side, not on Sloan's side. Inventory. They gave us a ton of information about inventory going back and forth between both Porter and Sloan. So let's start entering some information in here. From the Porter side of things, it tells us that they had unrealized profits of $14,000. So let's grab it. And on Sloan's side, that they had unrealized profits of $1,500, and those were our beginning amounts. We'll take the same approach of doing 40% for the tax column, and then our total will be the difference between the two. So let's carry over that formula. There we are. Now let's think about the accounts. What accounts are we going to be impacting here? Oops, let's get it on the right side. So for beginning, when Porter is selling it, well, we want to back it out, and then we're going to back it out to COGS. Remember, it's going to be an inventory transaction, and the offsetting account will be COGS. Think about it. It should be a credit. And I know that seems very difficult when you're wanting to offset it, but you want to bring down your COGS amount because you're sort of almost like realizing your beginning inventory, and then you're going to be sort of unrealizing your ending inventory. So we start off with our credit to COGS for both upstream and downstream transactions. Then our tax is going to be sort of our income tax expense. Same thing, upstream and downstream. Now here is where it gets a little bit different. So when Porter is selling to Sloan, it's a downstream transaction. Therefore, the accounts it's going to impact the most will be PANI and POR. So we are going to have, let's start off with our debits, a debit to POR for the prior transactions, like in prior year, and then we are going to do a credit to PANI for the current year impacts. Of course, on the Sloan side, when it's an upstream, we are going to debit SOAR and credit SANI. This is very much similar to what we saw in Chapter 6. So now the ending inventory. Of course, the ending inventory is going to be truly unrealized. So let's grab our figures and plunk them in. For ending inventory, we have 10,000 is outstanding here, and 2,500 for Sloan. Same approach. Of that at 40%, and we'll just take the difference between the two. Now, it's almost going to be the opposite of what we saw above. So for the total amount, we're going to be debiting COGS. Why? Because it's unrealized. And so rather than impacting inventory or anything else, we just sort of increase COGS, which recognizes that we have not sold it to an external party, which brings down our NI and adjusts our financial statements to capture that transaction. Same thing for the ending inventory of Sloan, but we're also going to have one additional line item here. We want to credit inventory. Then for our income tax expense, we will first start off by debiting our deferred income tax and a credit to our income tax expense. Oops, let's try first working on our spelling and then typing. Of course, it's going to be the same for both upstream and downstream. The big impacts are actually in our totals. So when Porter is selling down to Sloan, how we're going to capture it is actually within our PANI. So the adjusted assets on the parent side. When Sloan is selling to Porter, we're going to capture it both in SANI and SANA. So SANI here and a credit to SANA. Now, at this point, I am going to be making our third video to really show you how we can now calculate our the patent amount, our goodwill amount, non-controlling interest, retained earnings, and long-term liabilities.